Hey everyone, welcome to the Note Investor Podcast. I'm Dan Deppen, and today I'm joined by Justin Bogard from American Note Buyers. So Justin, how you doing?
I'm doing awesome, Dan. Thanks for having me on.
Yeah, no, glad to have you back on again. It's been a while. I've had you on
Yeah.
before. I think it's been like a couple years. My podcasting was kind of intermittent for a few years there, but now I'm getting a little more regular. But no, thanks again for joining. So maybe tell us a little bit about what you guys do at American Note Buyers.
Yeah. So as our company logo says, American Note Buyers, we buy real estate mortgages all across the United States. We're mainly buying performing mortgages, and we have a real estate debt fund that we started last year. And so we're raising private capital from investors. And our fund is mainly concentrated on performing first lien residential single family loans. We
Hmm.
do, spar off every now and then to look at non-performing and other assets like that. But our main core function right now is to build the fund up to have a lot of passive cash flow, and the performing loan market is really what I'm heavily investing in right now.
Okay, so yeah, so you're looking for more of that steady cash flow versus the wild west of non-performing and things like that.
You know, it's that timing is everything, as you know, in this business and really any other business, especially in real estate. And when I got started back in 16, early 16, non-performing was the hot item to,
Hmm.
like, it was the sexy item, like, hey, let's go after and get these. They're pretty inexpensive right now. There's a ton of them out there. There's a lot of these contract for D lane contract type of things. And now I'd probably say the last 3 years at least, if not four, it's not been the non-performing that's been the sexy. It's been more the performing and the reperforming. And the reason why I think that is because all that non-performing that was really cheap is kind of flushed out, and you're not really
Hmm.
seeing that anymore. And so I know we had you on my podcast the other day, and we laughed about the fact that non-performing is the same price as the performing. So why not just get the performing?
Yeah, that was kind of my path as well. Like I
Yeah,
started a little after you, around like 17.
yeah,
Yeah, and it was the same thing, a lot of like non-performing land contracts. And then you started to see fewer, and then pricing went up to where the spread between performing and non-performing was so close. So it was like, well, I may as well buy the
yeah.
performing at that point.
Yeah, the non-performing, as you know, Dan, it can be extremely lucrative, and it's high risk, high reward, as you would imagine with anything.
Hmm.
But it's just sometimes it's just a time suck, and you sometimes, especially if you're buying the ones that are, I'll just throw a dart out there, like under 80,000 in unpaid balance. It's really tough to get those back and make a large margin on them unless you get them reperforming. So we like to focus on the ones that are at least over 125K in UPB, because we feel like the house value is probably going to be closer to 200, and
Hmm.
we'll have a better chance to, be able to sell that to a local fix and flipper as is if we have to go through foreclosure. We hope to get it reperforming, but sometimes that doesn't happen.
Yeah. So when you do those like larger loan balances, do you run into a more sophisticated borrower ever? Like I know for me, when I've gone through the legal process on, like, say, like the lower value contract for deeds, it's rare that the borrower kind of like tries to fight. Occasionally they do,
Yeah.
but not as much. Like I've had people say, like, you to get into the higher value properties, you can run into different borrower behavior, but I don't have much experience in that realm myself.
I've heard that too. We haven't ran into that a whole lot. We just kind of work with that borrower as best as we can and be transparent with them and say, "Hey, look, we don't want to foreclose on you because honestly, it's more work for us and we don't want your property back. We'd much rather have you perform, what can we do?" So I haven't ran into the we'll call the sneaky borrower.
Hmm.
But I have heard of that before, and borrowers do have rights, and they can squat there for a while if they want. I mean, I have loans that have taken well over a year just to get the property back because they're able to sit there and they're able to go through the process of not having to really do anything and stay there. And even after it's foreclosed, they can still stay there a little bit longer, sometimes a few months to, a half a year, to go through an eviction process. So they can work the system, and it has happened to us on lower valued assets before. And it just kind of is what it is. You got to expect that with non-performing, that you're just going to have that difficulty with it. So if you're going to look to flip something quickly with a non-performing loan, just, don't be surprised if it takes a year and a half.
Yeah, you mentioned something in there that's interesting that some people may not realize, right? Is that the after the foreclosure is done, they may squat and you may have to evict them. So just because you've gone through the foreclosure, you're not necessarily done at that point if the borrower doesn't just leave on their own.
Yeah, my recent experiences have been in Michigan, and they've been contract for deeds or note and mortgages or note and deed trust, depending on what it was up there.
Mm-hmm.
And so we've had borrowers just stay in the property, even though they're communicating with us. They just, they're just not leaving, and we foreclose on them. And it may take, 120, 180 days to foreclose in Michigan. It's not very long at all, but when they are still in the property, they're allowed to redeem that, right? And so there's an eviction
Mm-hmm.
process, and sometimes it can take 6 months to do that. So
Yeah,
it ends
because
up
what
being
is
a
it, a
year and a
six
half.
month redemption in Michigan, or three for a land contract and six for a mortgage, something like that?
Yeah, something like that. And so the only thing that we can do is just follow the letter of the law, and just have our attorneys keep paying the courts, and then the courts have to be available, right, to have your judgment entered, and your not your judgment, excuse me, your eviction entered, so that they can go through their process. And then sometimes they're trying to be lenient with the borrowers and understanding of their situation, so they might extend it or have a recess, to further it down the line. And so yeah, that stuff happens. But you get kind of
Yeah,
antsy as the lender after a while and be like, come on, guys. I mean, they haven't paid for 13 months. Like they're obviously working the system here. So
yeah, and I've seen a lot of variation in eviction time. Sometimes it's based on like how busy that sheriff's department is, or
yeah.
how fast they want to go. Like sometimes they're pretty quick. Sometimes they're just like, yeah, we'll get to it when we get to it. And then of course during COVID, I had some where it got really messed up because courts were closed
Yeah.
for a while and they just weren't worried about that kind of stuff.
Well, we've had sheriffs in a couple of different counties in Michigan to where they bring their own crew once they schedule the eviction to kind of empty the house out for you, which is awesome. But
Oh, that's
then,
cool. I haven't had that.
it's a monopoly, right? Because they charge whatever they feel necessary. And so you're kind of just handcuffed there and just be like, okay, this is, you know, $7,000 eviction. It
Oh,
can
that
be,
stinks. I haven't had one of those,
yeah.
but yeah, the other thing that's tricky for me too, especially when you're in northern states like Michigan, is sometimes the borrowers just take off in the
Mhm.
middle of that process, like even if before the foreclosure is complete. And they're not necessarily going to tell you that they're going to do that. They're not necessarily going to winterize the property. So it gets tricky where I've had frozen pipes before. You got to somehow find a way
Yeah.
to try to keep an eye on the property. But I mean, it's hard. Like you're not going to send somebody to go look at it every single day.
Yeah, and I don't want your listeners to assume that this happens every single time on a non-performer. These are just kind of outliers that you just have to be aware that things can go bad pretty quickly with non-performing, which is why we started off saying high risk, high reward.
Yep.
But yeah, so they'll take all their belongings and put them out on the front driveway if they have one, or the front area, and they have, you give them so much time, like 24, 48 hours to get it. And they don't get it, then it's your responsibility as a lender, because you're actually the owner of the house now, because you have the title. You have to get it off the property and get it thrown away or sold it or put it in a storage unit or whatever you want to do, or else you start getting fined by the city, right?
Yeah, I had one in Cincinnati like that. Like the rules in Cincinnati were you couldn't just clean out the property. You had to clean out the property. And as you said, put everything out on the curb. And then the borrower had some amount of time, I forget what it was, 48 or 72 hours to get their stuff if they wanted it.
Yeah.
And then you had to get it all removed. So you're kind of paying for like two cleanouts. Like you're
Yep.
moving it from the house to the
Yep.
curb, and then you're moving it from the curb to the dump. And it got weird because like it was wintertime and there was
Yep.
some weather. And then the sheriff ended
Yeah.
up asking if we could delay, and we're like, yeah, because it was like a snowstorm. Like, how is this even going to work? Like,
Yeah. Yeah. You're hoping that the neighbors just pick through everything and just take care of it for you. But more than likely, what they have is just not valuable stuff, anyways. Otherwise, they would be concerned about it and take it, like, big TVs or something like that. So,
Yeah, I've never seen anything valuable there. I have to wonder though if I've ever like thrown anything away that was like people had like money squirreled away or something jewelry.
would
You
be
don't.
interesting. I haven't either. I don't know. I get to see the pictures, but I just get to see pictures, not like them going through everything and like showing me like, hey, this is this, and hey,
Well,
this is
that's the
that.
other thing I wonder, right? Because if they're going through it and they do find something that's juicy, they're not going to take a picture of it and send it to me.
Yeah, I mean, this
So,
is
so I
just
kind of wonder what I've missed out on. Yeah.
yeah. You gotta pick your poison. I just want the property back if I know that's my last resort, just so I can put it on the market and resell it. So that's
Yeah,
and luckily
exactly.
in this environment, you don't have an issue selling the property as is because inventory is so low pretty much everywhere in the Midwest, and it's not going to take much effort for a local rehabber to go through and just kind of do what they need to it. So typically you are at lower risk of not losing your money, but you definitely can spend a lot of money quickly if you're not paying attention and careful with that. So
Yeah,
non-performing can
that's
be
a good
fun.
call out, right? Especially depending on how big the clean out is. Like I've gotten quotes from some like national services. Like I had
Mhm.
my hoarder house that one time that I talk about all the time. And I was getting these enormous quotes of like $10,000 plus to clean it out. I ended up hiring some guys from Craigslist and ordered some dumpsters and got it taken care of. So sometimes if you're a little bit creative and you do a little bit of legwork, you can save
Yeah,
yourself a lot of money on
yeah,
those.
yeah. But
So when you
go
do
ahead.
sell the property, are you generally selling to local investors? Like, do you ever do seller finance or anything like that?
Oh
Or are you
yeah.
generally selling to cash buyers?
So I just have two options, right? I have a cash price and I have a private finance price. And
Mm-hmm.
I just have a local realtor. Typically, that's the REO agent that I'm working with, and we just say, I just want to sell it as is. What do you think it's worth? They're the local person down the street on it, and so I just
Mm-hmm.
say, here's my cash price, here's my private finance price, and I don't give them the specifics of like the interest rate and all that. I say here it's X amount of dollars, this much a month rent, and I need this much down payment for however many years. Just keep it kind of simple like that.
Yeah. And then how do you find those REO agents? Because that's kind of a specialty. Like most realtors aren't familiar with REOs, or it's not necessarily what they do. Or if you say you offer seller financing, some people get confused.
Well, it's who do you know? And who do you know in the area of Michigan that can help you out? I have a friend that it had a tight knit circle across the United States of just REO agents. So I typically would call them, this husband and wife, and they will say, "Hey, I know this person. They're close to whatever Lansing, Michigan," and call
Mm-hmm.
them because they're my friend, and they'll help you out. I mentioned their name, like, "Oh yeah, I know such and such. Yeah, good people." And so that's kind of how I've been working the REO agent route. You can always just call, you know, the realtor office that's closest to your property and say, "Hey, look, I have this, dumpster fire here. I have this REO property. What, do you guys do that type of work, or do you know of another local agent that does that?"
Yeah, I've done that before too, and that works pretty well. And usually in my experience, like the first one you call isn't the REO agent,
Yeah.
but they often know. Or if you just call a couple, like you'll kind of track them down
Yeah, you don't want to
before
make
too
them,
long.
yeah, don't want to disguise anything and say, "Hey, this is like the best listing you're ever going to have." You'd be like, "Hey, this is a piece of crap here." I'm just trying to sell it to somebody that can fix this up, that, is looking for a nice home that they can put some sweat equity into. There's a lot of tradespeople around in these areas that are, blue collar cities, blue collar neighborhoods. So
Yeah, I've had buyers like that. Like those are great when they actually like being able to take that on, right? 'Cause especially a lot
yeah,
of mine are kind of lower dollars. So, they're buying it and their payments less than what rent would be, and then they own it and they
yep,
can fix it up and do what they want with it.
yeah,
So
exactly.
so maybe we could talk a little bit about like what you do to fund these deals and raise outside funding for your funds. I know it's something that people are often curious about, and they get kind of surprised when I tell them it's not as difficult necessarily as they might think.
As far as like somebody wanting to set up a fund and raise money,
Yeah, or basically just
yeah,
raising outside money in general, and yeah, particularly for a fund.
you just have to be careful. There are SEC guidelines that we need to follow and be aware of what we can and can't say in initial conversations. So, for example, our fund is a 506B, and so we are supposed to be talking to people that we've about the fund when we've established a relationship with them. And that relationship isn't necessarily one or two conversations, it's like multiple contacts. And, so at first you kind of have to send out some sort of education about what we do. Like, we're note investors. We invest in the debt on properties. Here's a webinar. We're going to show you kind of what this looks like and what we do. And then maybe you have another conversation with them or two, just more exploring about this to see if they want to invest in like notes and like help them out. And then, the other option ends up being like, well, if you don't want to do all this work or really gain all this knowledge or have this responsibility and learn this new skill set, then why don't you just invest in our fund? And so
Mm-hmm.
that's kind of how the conversation works with the type of fund that we have. We call it a friends and family fund. You got to get to know somebody first. Other funds that are out there that have different criteria, they can just start promoting it as, the first time that they're meeting somebody, like, hey, we have a fund and this is the rate of return that we have. This is what we do. So
Those would
for
be like the
ours,
506c funds for accredited investors and things like
yeah,
that. Yeah.
Yeah, so once you're considered an accredited investor, the IRS assumes that you have more intellectual knowledge about investing in general and you really understand the risks that are associated with it because you have made good amount of money. And so that's just the theory behind it. The non-accredited investors doesn't mean they're not educated, it just means that the IRS doesn't see them as experienced enough to make wise investment decisions based on risk. And so that's kind of why they put that category in there.
Yeah, I find that to be like a hilarious assumption that they make across the board at a government level. It's like if you have more money, you must be smarter than the other person. Because I've known people with large amounts of money that have done some really stupid shit. So I don't.
Yeah.
It's funny that they actually have that like codified in
Yeah.
the rules.
Oh, I mean, think about it. Any professional athlete that makes a very large amount of money when they go into their professional sport at a young 20-year-old age, I mean, of course, they're not going to be responsible financially unless somebody's helping them out because they don't know any better. Like they're used to living off of X amount of dollars and now they have millions of dollars all of a sudden in their bank account. Like they're not going to make the best decisions probably at first. But yeah, I get what you're saying. It's but that's the world we live in. We have accredited and non-accredited investors. It doesn't mean one is better than the other. It just means the IRS says, hey, look, this person we assume has more sophisticated knowledge on the risks associated with investing their money, and this other person just may not have enough experience in doing that.
Yeah, that's like folks with trust funds. I would put like in the same boat. In fact, here in Colorado and
Yeah.
Boulder, we even have a name for that. They're called the trustafarians. They're the trust. Yeah. So now you said you've kind of like pivoted over the last few years to focus on non-performing to performing. Like what other kinds of things are you seeing in the state of the market right now as far as like levels of inventory and trading activity and areas and
Aggravation.
things like that? Aggravation. Yeah.
So so I'm fortunate enough that I do some contract work for a very large trade desk. So I see a lot of seller finance loans that are wanting pricing on them. And whether it's residential, commercial, mainly first lien, land as well.
Mm-hmm.
And what I see the most often that is probably the most aggravating is just the lack of knowledge on how to be compliant and to create really highly marketable seller finance loans. And so there's a lot of people that are discovering now that are just real estate investors. They're smart people. They know what they're doing. They can fix and flip houses. They're really good at that stuff. But when it comes to the financial part of it, they just don't know what they don't know.
Mm-hmm.
And so they are starting to realize that the banks are not lending out money as easily as they did, a few years or several years back because of the buy box, as we call it, for the buyer. Got to have a strong credit score, got to have a strong down payment. You can't have, iffy credit with creditors in the past. Like you got to be pretty solid for a bank
Mm-hmm.
to finance you. So now the other option is, hey, I'll just sell you my property and I'll carry back terms for you because I can just go sell that note. Yes. Yes, you can sell that note and yes, you can sell it, when it's created, but you have to create it in a manner that's compliant, number one. And then number two, you have to create it in a way that a Dan Deppen or a Justin Bogard would buy it and not, take such a steep, you would have to take such a steep discount. So what I'm seeing is new originators out there that are new to the seller financing and the private financing creation world that are just doing things in a way because they just assume that someone's going to pay 100 cents on the dollar for their note or what we call par in this business. So
Mm-hmm.
meaning if they created a note for $100,000, they would expect Dan and I to pay $100,000 for it, and they don't understand why we'd want a discount. And so that's the biggest aggravation that I have right now is
Right. And
looking
then
at
you
that.
can't close with them because you're going to have to you're going to need a larger discount to get to the proper rate of return, and then they don't want to sell it at
Yeah, and
that
it's not
discount.
and that's what they assume our metric is a rate of return of X. And it's like, no, our metric is the risk.
Mm-hmm.
So it's the risk associated with that borrower. Like it's not just the property value, it's the borrower. If they don't continue to pay, then you just lose out on your performing loan. And that's what they don't realize. Like, well, I ran them through an RMLO. Yeah, that's great. Today their credit and their availability of credit is this, but what about the year down the road? Things changes. Like you still have to show like a track record. So
Mm-hmm.
it's hard to get the education out in the right way because there's people out there that just make the assumption like, oh, okay, someone out there is going to buy a note because that's kind of the new sexy thing that's out there is to create a note and try to sell it. And if I hear the word table fund constantly in our space
What's
with new
table fund?
originators.
I'm not familiar with that one.
Well, so they are creating paper, and let's say you sell or finance one of your properties right now, and you're going to the closing table tomorrow, and you're actually having the borrower in there. They're signing the paperwork. They brought the down payment, and you're closing on it, and the transaction's happening. Well,
Mm-hmm.
you would expect somebody like me to come in at the same day, at the same time, and fund the note from you. So you are
Oh,
getting a down payment and money for the note at the same time. So they call that table funding.
uh-huh.
And so that transaction typically doesn't work at all. There are situations where it can work, but typically for an amortized loan, it's not going to work out very well or very easily because it actually is very complicated for the title companies once one of us from the secondary market for a note buying come into play.
Mm-hmm.
It gets too overwhelming for them. And this, I've tried it before. I've tried it more than once, and I know how difficult it is because they're just not used to what we're trying to do, and they're not understanding that there's a discount, and it's just very confusing to them. And I can totally see that because they don't have experience in our world. So we typically will fund things if it pans out, if it's compliant, if it meets all of our parameters and our requirements, within like a week of them closing anyways. And that way we
Mm-hmm.
can have a kind of a virtual closing just outside of that so nothing gets confused. Because by all means, it's not like, a few more days isn't going to hurt them by not having that money in their hand.
So is the thing that trips them up, because like with like traditional closings, it's not uncommon for there'll be some third party bank that's taking on the mortgage. Is it that you as the investor are not necessarily buying it at par, so there's like a discount right off
That
the bat?
Well, yeah, the first complexity is the seller carrying back the financing. So that's just a little confusing to title companies because, like you said, they're used to having a conventional, like one of the big five, come in
Mm-hmm.
and just fund the deal. So that way, and they're used to that. So the carrying back the financing is a little bit more complex for them. And then on top of that, if someone was buying that said seller finance note created, so that's a fourth party or a third party that's coming into play, and they're having their own transaction. So it's like you're doing a triple closing at the same time.
Gotcha.
So that's where the real complexity comes in. So I've done it before successfully, but I've had to be, in the driver's seat to help steer the whole conversation of like, okay, this needs to happen. This is on the closing statement, and it just becomes too overwhelming. So you might as well just wait a week and just fund it after the fact.
Yeah, and I almost wonder, like you as the lender, do you require a mortgage loan originator license to do something
Ah, great
like
question.
that? Because you're actually originating now, and this is where I
Well,
ask because I get confused on these rules. Yeah.
so then I wouldn't be originate. So that's where we kind of bypass those rules is because we are not actually originating because the person that's selling the property is originating the loan. They're actually going to collect the first payment. Even though we may be paying them for the note before the first payment's made, we just make it the stipulation that, hey, you still are collecting the first payment as well. And we'll just deduct that from the sales price. And so we can get them their money sooner. It's just that's how we kind of avoid being the originator. So we make sure that they're compliant by using an RMLO anyways. But
Mm-hmm.
yeah, we are not really the originator. We're just the secondary note buyer that's just making the first note transaction after it's been originated.
Oh, gotcha. Because I believe there are rules where if you're going to originate more than, I think it's 3 seller finance loans a year, you have to be licensed. But since the mom and pop is the originator and the seller, they don't really fall into that because they're doing basically one of them.
Yeah, you're kind of right. So the rule of thumb is 3, but you don't have to have a license. You just have to use an RMLO.
Mm-hmm.
So as long as you're using an RMLO or somebody that is licensed to do that, to underwrite the borrower. That's third party, unbiased. Then you're still within the rules. And we just tell people to do that anyways. Don't try to do three of them and then use an RMLO. Just use an RMLO anyways, because I mean, you're only going to make this note more attractive to somebody else when they can see the borrower's credit, especially if they're buying something that's kind of unseasoned or that doesn't have a lot of seasoning to it. So like
Mm-hmm.
we'll just say less than like 12 to 13 payments. And that's
Okay.
what we would see.
Gotcha. And where are you finding the RMLO? Is that through the title company or is that like a third party?
So they're typically not through the title company. There are RMLOs that just focus on one state. Like there's a couple of them in Texas that just do Texas only. There's a couple of them that do like 4 or 5 states, and there's one that I know that does all the states. It's called Call the Underwriter, and it's
I've used
Max and
Max
Michelle
Bailey.
Bailey. Yeah,
Yep.
Max and Michelle, they own it now, and so they kind of they can do underwriting all across. Now there's a cost for it, and you want to do all this stuff before you close, obviously, but you can also add those fees to the settlement statement to where the borrower's getting charged. They can call it an origination fee, or I'm not sure what they call it exactly on the settlement statement. Maybe it's called an
Mm-hmm.
RMLO package or whatnot.
Gotcha. Yeah. The other thing I like to do on those is have the borrower pay for the servicing fees going forward. Like usually no one bats an eye at that, but it kind of juices the value of your loan. It just simplifies things.
Yeah, because then your net is the gross payment.
Right. Exactly.
Yep.
So no, very, very cool. So I was trying to think of now what else I was going to ask you. I
Oh,
totally, I think,
that's all right.
yeah.
So
So,
so that's I guess that's my aggravation is um the folks that don't know what they don't know when it comes to originating loans. That's what I see that is probably a problem right now that we need to kind of help resolve. Because if we can create a lot of good paper, that's just more paper that you and I and other people just like us that can go buy and make everybody happy. Because ultimately, we want to make people make passive income, and then us as people that can manage that part of it, we end up making money as well because we can have good inventory to sell and can sell it for more of a premium because we can set it up in a manner that is just more hands off than typically what you and I would see and have to do in the beginning, anyways.
right. And are you mostly buying like newly originated or recently originated seller finance notes, or do you ever go looking for existing ones that are floating around?
Yeah, we definitely like the existing ones because they have that long pay history to show us, the propensity for that borrower to repay. But more than not, we are buying newer originated loans. I would say anywhere from probably 6 to 24 months is probably the most common that we're seeing right now. We do see a lot
Uh-huh.
of them that have no seasoning to it, but we have like a big caveat, in there. It says subject to, got to check the house value, got to check the credit, got to, we got to check this, that, and the other. So it's under the microscope a lot more if it's brand new, but if it has a
Yeah.
few payments and stuff and they can prove some things, we like that too.
Yeah. And if it's brand new, in theory, the seller should just have all that data, right? Like they should have done something to figure out the valuation and have all the title work. I'm always a little surprised, like sellers don't make it easier for buyers by just giving you like a package, like, here's all the details. We just did this. They kind of make you go figure it out, it seems like sometimes.
Yeah, it is odd that it happens that way because you figure this is a very expensive investment for somebody, and they're doing the least amount of due diligence on it up front, as opposed to them like selling their car or selling something that's more common. They know everything about it, right? And they're happy to share all
Mm-hmm.
this information. But when it comes to this, it's just like I would laugh when landlords that don't screen their tenants are like, well, they had a deposit money of $800, so I just figured I signed them up for 12-month leads. It's like you don't even check their criminal background, you don't check their, history. Like, yeah, you definitely you definitely want to check this out because there's no guarantee that your note will sell to somebody. You have to find the right person to buy it as well, and you could be sitting with it. So it's just the idea of people that originate loans with the intent to sell it quickly. It's like that completely defeats the purpose of doing the seller financing. Like
Mm-hmm.
you're doing the seller financing to be the bank. You're doing it to create cash flow and to create wealth. And unfortunately, there's just probably, let's just call it 85% of the real estate investors out there are very transactional and they
Yeah.
don't want to get cash flow, whether it's rent or whether it's being the bank. They just want to be transactional.
Yeah. It's the caveman brain. People want stuff
Yeah.
now. I mean, there's a reason why Warren Buffett has become the richest guy on earth over decades, and he's very transparent about exactly how he does it, but nobody quite mimics it.
Right.
Even though it's all out there, it's not like he has secret information. It's just our brains aren't necessarily wired to go longer term.
Maybe it's like a competition internally with people be like, I want to flip the house to make the most profit on it so I can brag about it. Maybe that's the mentality of it.
There's some of that. I think it's just yeah, like I think our brains are just wired for the short term, because I think for like hundreds of thousands of years, like the long term didn't matter much, because if you don't worry about the short term, you're going to get eaten. It's going to be all over. So
Yeah. Well, cost of living is going up. Everything is going up. So it makes sense logically why people just want to be more transactional. But, you know, in the beginning, when you're starting out, you kind of have to be transactional to a certain point, but you also have to start forcing yourself to have some more wealth building tools. Like, obviously me as a fund manager, it's a wealth building tool because I don't make all my money today. I really make it when it sunsets, right? When I'm able to liquidate the fund and have the waterfall come out, and what's left over is really what I get. The management fee really doesn't pay the bills. It's just there to kind of help ease the burden of running the business. So
yeah, because I've looked at fund models myself in the past. Yeah, and you're just sort of, those fees are just sort of to keep the lights on
yeah.
and kind of keep it running. So, well, very cool. Well, Justin, thanks again for joining us, and love to have you back on again a little bit later this year. And I'll be seeing you. Well, this will air, I think, about a week before DME, so I'll be seeing
Okay.
you there pretty soon
Yeah.
as
Definitely see you
well.
there.
All right, thanks.